Welcome to This Week in Money. I'm Jim Goddard. Today, Ross Clark from chartsandmarkets.com looks at the shortened trading week and why markets across the globe fell just before closing on Friday. Gold and oil may turn out to be the big winners. John Kaiser from KaiserResearch.com explores 2020 on the junior resource front. With geopolitical fireworks heating up, he believes sticking to investments in the U.S. and Canada might be a good idea. Ross Kay from thewealthyhomeowner.ca gives us his forecast for major real estate markets across the country. He warns real estate organizations may give a rosier picture than what actually is there. Plus, at the end of the show, we'll have a company showcase update from American Manganese President Larry Reaugh. We'll talk to Ross Clark right after this.
Avon Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark from chartsandmarkets.com, where you'll find insightful market commentary and timely technical analysis. Welcome back to the show, Ross, and best of the new year.
Best of the new year to you, and wow, what a start to the year. First trading day of the year, pretty much across the board, every equity market that you can look at, either side of either ocean. We're sitting at record highs, and overnight, a name of Soleimani becomes significant. So the action that the U.S. took there in Baghdad turned us on a dime. Very interesting action. This is being the beginning of the year. This is historically a time that you can see some pretty significant reversals, and especially when you're coming from excesses such as we've had in December. So I'm really looking forward here to the next couple of weeks and how this unfolds, because the chicken scratches that I look at on the charts are all set up for some pretty good action.
This missile strike, drone strike in Baghdad, what has it done to oil prices?
Well, pretty much as you would expect. When something's directly related to something in the Middle East like this one, you'll see a spurt. And we saw it when the Saudi Aramco was hit in September. There was a spike up at that point in oil. This one, we tacked on a couple of dollars here, closing up at $63. For us, this is what we were hoping for, a $63 to $64 target, top of the trading range. We really, we talked about this the last few weeks, wanted to have this end with a spike to the upside so that we could get a big relative strength reading. So the RSI is up to 76 on the index right now. The optimum that we were hoping for would be an RSI up at 80. So it's within spitting distance, and the price level itself is getting up close to the upper band that we were looking at, and that band has moved up with time, but we've come within 50 cents of that key resistance right now. And when we look back at the 10-year cycle, there is a turn-of-the-year move in each of the preceding decades, that going into 2010, going into 2000, and going into 1990. So here we've got a news event creating upside action, probably peaks out here in the next couple of days, and wouldn't be at all surprised. It's hard to say what the retaliation will be for the strike that we had in Baghdad, whether it's quick or whether it takes months before anything resolves there in terms of retaliatory action. But in the meantime, wouldn't be at all surprised to see us settle back towards maybe the $56 range. That would be the norm. when you're coming out of this base that we've been in. We bottomed in December of 2018, so we've had a couple of good waves of buying and some corrections. The next correction down into the mid-50s should be a good buying opportunity.
Are people going to rush to gold with this uncertainty hanging over us?
Yeah, well, this is, the classic is that they rush to oil, they rush to gold, and they rush to U.S. Treasury bonds. And that's exactly what happened here. The precious metals on Friday, you ended up with a great day for the gold market, trading up now through 1550. We haven't seen that in months and months. Silver had a mediocre day. Platinum did nothing. And so it's that flight away from risk into safe haven items that is entirely expected when you get overnight news such as we had. The key here now, though, is that historically times like this tend to see interim highs fairly soon thereafter. So there was a gap up on Friday. I would say that you can allow for that gap to be filled. However, you don't want to see it do much more than that. Otherwise, gold could be, in for a deeper correction. But for right now, the seasonals as far as precious metals are positive. You get that November, December bottom. You peak out in usually January or February. And as long as the momentum is working here for these, you want to ride with them. But as I am always too cautious on the big breakaways, I'll say that you want to make sure that your stops are reasonably tight.
Ross, thank you so much for being on the show.
Well, nice to be off to an action-filled start to the year.
Next week will be interesting.
It will.
My guest has been Ross Clark from chartsandmarkets.com. Coming up, John Kaiser next on This Week in Money.
Always consult your investment professional before making any investment decision.
Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. My guest is John Kaiser from Kaiser Research. You may be familiar with John from his show Discovery Watch on HowStreet.com radio. Welcome back to the show, John, and Happy New Year.
Happy New Year to you too, Jim, and our audience. Glad to be on the show.
John, one of the things we like to know about our guests before we really get into the interview is, what is Kaiser Research all about? What's new there?
Well, Kaiser Research covers the resource sector, companies, all the companies listed on the Canadian and Australian stock exchanges that are involved in the resource sector. It's an information portal. But in addition to that, I come up with stock picks, my favorites for 2020. I just published them yesterday. There's 23 of them. About half of them are new companies, and we're quite optimistic that in 2020, this 8-year bear market for the juniors, resource juniors, will finally turn around on the upside.
Is the U.S. dollar key to the pricing of commodities?
Commodities are priced in U.S. dollar because the U.S. dollar is the primary currency used around the world, but sometimes when the U.S. dollar goes down against other currencies, metal prices tend to go up. And so people always hope that, if the U.S. dollar goes down against all these other currencies, we should see an uptrend in the metal prices. That's fine for gold, but for the other metal prices, it doesn't necessarily change the underlying economics of producing that metal. So it's key in the sense that if the U.S. dollar goes up in relative terms, the metal price will be flat or trending slightly lower because the rest of the world is still consuming those metals. And if the U.S. dollar goes down, we should see a slight rise in it, but it's not the sort of thing that makes a huge difference to the resource juniors.
How are the various junior resource sectors looking for 2020?
We can divide it into two groups. There's the precious metals, mainly gold and silver, which is linked to either inflation expectations, for which there aren't any significant expectations at the moment, or uncertainty. And I think uncertainty is the big concern going forward. I see uncertainty rising over time as a result of the policies that the United States has initiated. And the other thing is the macroeconomic future. Right now there is a lot of uncertainty about whether the global economy will continue to grow or stall and start to falter. The China-U.S. trade war seems to be tentatively resolved, but the key underlying issues have not really been addressed, such as China violating intellectual property from the West and not really allowing Western companies to operate in China. That has not really been resolved. So there's concern that demand for raw materials, commodities in general that are used for things as opposed to gold, which is not really used for anything, will not be particularly strong. In fact, might weaken, which would result in lower metal prices in 2020. So at the moment, the market for the juniors is sort of thinking gold is the space you have to be careful about the, copper. Nickel might be interesting because the Indonesians have now shut down the export of raw ore to China, for which they gave a waiver to those companies which were building production capacity within Indonesia. So that we could see a better nickel price in 2020, even if the global economy doesn't particularly grow very well. The one hope we have for the sort of the base metal sector is that the United States may finally get on with infrastructure renewal. The interest rates are still very low. Neither party cares particularly much about how high the debt is, unless, of course, it's the Democrats in charge. Then the Republicans will care an awful lot, but right now, since they're in charge, they don't care. So rebuilding America's infrastructure, the electricity grid, the transportation infrastructure, the bridges, all of that, that's something which, of course, would crank up the debt, but it would keep the economy going. It would help make America great again, and it's something that appeals to both sides of the political spectrum. If something like that kicks in 2020, that would really buttress the macroeconomic outlook because it would increase demand for raw materials. The rest of the world would see that. The rest of the world would follow suit, and we'd get out of this uncertainty that we're in right now, where gold, where we're wondering if the economy is going into a downturn. And even though it's going into an upturn in the macroeconomic sense, that wouldn't be harmful for gold just because uncertainty is declining, because there will still be this issue of endlessly growing debt, so people would continue to worry about that and use gold as a proxy to hedge against that concern.
Is money likely to move from the cannabis and cryptocurrency sectors into the resource sectors?
That is not likely to happen from investors. The cannabis bubble has peaked. Apparently there's 400 tons of marijuana parked in Canadian warehouses. That's about 1 billion joints that Canadians need to smoke as soon as possible so that they can refill those warehouses with more of that. What's happening now is we're in the declining part of the bubble. The market's in a sort of a denial phase right now. The fear is going to kick in soon. And those who are long and rode it up and liquidate, that capital might go into the resource sector. But the resource sector needs to have a very visible uptrend before the money that was made in cannabis comes in. The money that comes into the resource juniors really has to come from elsewhere, from people who haven't recently suffered big losses chasing a trend, because everybody always remembers that the trend was their friend until it isn't, and then they remember that one shouldn't do that. So looking for new audiences that did not get burned in cannabis or crypto. Crypto itself is pretty much dead at this point. It's kind of hilarious that crypto mining operations are even better at losing money than the actual mining industry. So no, maybe the promoters in that will redeploy their capital that they took out of the cannabis audience and start putting into resource sector. And that's the sort of phase we are in, is this gradual shifting of the sort of insider, the smart money, into resource sector, because they smell that after 8 years of bear market for the resource juniors, it may finally be time for a gold-driven turnaround in that space.
The newly elected Trudeau government doesn't seem to be too friendly to the resource industry, combined with over-regulation. Is this a concern for resource juniors with projects in Canada?
I think a bigger issue is delays associated with First Nations trying to make sure that they're getting a proper piece of the action and giving the green light for the social license for work. Canada's a commodity producing nation, and its rules are designed to protect the environment and prevent a legacy such as what mining industry did in the past, continue to ruin stuff, but everybody's adapted to the new rules. I think a bigger concern is in other parts of the world, say Latin America, where we see rising instability, civil unrest about the unfairness of the system, and also local communities being hijacked by external shakedown artists and opposition to mining and exploration happening in these jurisdictions. I'm more comfortable with projects in Canada and the United States than I am in Latin America, and in places like West Africa, where the French are reconsidering their relationship. The United States is considering pulling out, and we have the Islamist movement spreading in that sub-Sahara region there. I would rather be in Canada and the United States dealing with the permitting obstacles. In the United States, Trump is trying to have the overreach in permitting dialed back somewhat, and I definitely think there is room for that. It shouldn't be protecting the environment at the expense of domestic production capacity, and Canada needs to have a similar attitude. I think it'll balance out, and I'd rather be backing a project in Canada and the United States than somewhere in Latin America.
Do you see geopolitical concerns for the resource juniors in 2020?
And that relates to the question that you just asked. Again, I think the relationship between China and the United States can escalate. That there's the North Korea problem over there. We do not know what Kim Jong-un is going to do now that he and his romance with Trump seems to have fallen apart. And of course, whatever happens between the United States and North Korea will impact China. That, of course, affects the movement of goods around the world. China has its mitts in many parts of the world, such as Africa. It and Russia are rapidly moving into the Middle East as the United States withdraws from that area also. Again, I would say stick closer to home in this period of global uncertainty where big power games are back in vogue, and all kinds of crazy things can happen.
We'll have more with John Kaiser right after the break.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlin, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the 2019 drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. We're speaking with John Kaiser. John, do the gold and silver markets look like they're poised for a good move in 2020?
Gold has started off the year quite well. In fact, it started moving in about middle of December, and you can see in the resource juniors they're turning around. My last year batch of favorites, it was down 20% at the start of December, but by the end of the year it managed to be down only 14.5%. And gold for a while was sort of stuck in this 1460 to 1480 range, just going nowhere. But the ETFs, they've been accumulating gold. People are starting to realize we want to own gold. And today it was challenging the high achieved in September, early September, before it stalled and pulled back. Silver, of course, is going to track the price of gold because it's sort of the poor man's gold. It doesn't have the same dynamics because it is actually used for something, but because it's all embedded in some sort of application, the float for silver is relatively small compared to the float for gold, which is basically all the 6 billion ounces that exist above ground. The question many people are asking is, well, how far will gold go? And many of my peers, at least not the ones that are out on the fringe talking about fiat currency collapse and stuff like that, but the other ones are all sort of saying, oh, maybe we'll see 1625, 1650. I think they're misreading the situation. They're too shell-shocked. Yes, gold at 1260 is 1980 gold at 400 inflation adjusted to the present, and you look at that huge gain from $250 in 2002 all the way up to nearly 2000 in 2011, and then back to 1100. Now it's bumping at 1550, and you sort of think, well, maybe down is easier than up, but the reality is that big move was just a large inflation catch-up. The real price gains for the juniors and the producers was not that significant. I think we're looking at a situation similar to the late 70s when the United States appeared to be losing it on the global stage. We had the Iran hostage crisis. We had the Soviet Union invade Afghanistan on Christmas Eve of 1979. OPEC was putting the screws to the United States. At that time, we did have inflation, which we do not have today, but there was a lot of uncertainty back then. And we have a similar degree of uncertainty today about where American policy is taking the nation in terms of its global leadership role. We now have turmoil again in Iran with the attack, the killing, the airstrike on the commander, and all the uncertainty about what's going to happen over there. And when gold went from $35 to $850 and then stabilized at 400, that was a substantial real price move. Some of it was inflation catch-up, but most of it was real. That was a 400% move. Gold going to $2,000 is only a 33% move, and to $3,000 is only a double. But we're in a stage of repricing gold in terms of anxiety about the uncertain future that faces us. And I expect gold to blast through $2,000 in 2020 as more of this uncertainty translates into actual problems that nobody has an easy solution for. And that will be a real price gain. And of course, silver will track that, and it'll be tentative in the beginning, the move, but I think a lot of people will be surprised at where gold is by the end of 2020.
Do the resource juniors tend to have seasonalities?
And when I started in this space in the 80s as an analyst, projects were mainly based in Canada and some in the United States. And of course, Canada has a big seasonal component. Some places like Ontario and Quebec, it's better to drill in winter when the swamps and the lakes are frozen. But most of the time, the work gets done during the summer, and when winter arrives, everything shuts down. So we would see that January effect. Everybody's, okay, new season coming, stocks run up, the drums beat. Then we wait for the expiration results in September, and those that had good stuff, they'd do well, but those that didn't, they'd go back down, and we'd have the tax loss season. But after the 90s, when the Soviet Union collapsed and the whole world opened up and companies started getting projects in Africa and Latin America, the seasonality disappeared because these areas either have opposite seasons or don't have any seasonal constraints except the monsoon seasons, which they have a random distribution. So that old seasonality is not really the case. I am, of course, saying that we're going to be moving back to sort of the Canada and United States as a place where the juniors have their projects and do exploration. So the seasonal component does kick in. Places like Golden Triangle, nothing's going to be happening there until June again. So those companies which do not have a project, say in southern British Columbia where you can do work year-round, those ones will suffer that seasonal downturn while we wait for the next exploration season to come. But it's not the negative effect that it used to have back in the 80s.
Do you consider yourself to be a speculator or an investor in the junior markets?
Well, the junior markets are high-risk ventures where they basically have nothing, but are hoping to put ingenuity and dollars to work to discover something that is worth something. You don't invest in things like that. You speculate on these uncertain outcomes. So I would regard myself as a speculator. Now, the word speculator has negative connotations in the sense of people would speculate on the misery of somebody else and speculate in the market on momentum trades and stuff like that. But when you're betting on an exploration play that this target's going to turn into a big deposit, that is also speculation. And anybody who approaches these juniors, if they think they're investing, they need to think again. And if that's what they want to do, invest, they need to stay away from the juniors. And investing, well, if you've been playing the big senior markets, you've done phenomenally well. Will you continue to do that in 2020? I doubt that very much. And of course, if you want to invest in bonds, you're dealing with extremely low rates. And if for some reason inflation should make a comeback, you're going to be in for a big haircut. That's, in a sense, that's also speculation. But the financial industry prefers to call that investment. But with these juniors, it's speculation, not investment.
Are stockbrokers that focus on the junior markets necessary for the success of the junior markets?
Stockbrokers that used to specialize in the resource juniors were absolutely essential for the viability of the resource juniors. And that was in the sort of pre-internet, pre-discount brokerage age, and where you got a pretty good commission for every trade that you did, and it paid as a broker to be an information hub. You talked to the to the promoters, the street, and then you re-talked the story to your clients, and then the clients, of course, would talk to their friends and all that. There was really no place else to find out what was actually going on except the George Cross newsletter or Stockwatch, which would publish, the latest press releases put out by the companies. But now the broker's role has changed. Their job is to, collect money, get the accounts in, get some sort of fee for delivering a index tracking return. The less time spent talking to an investor, the better. But also, they have no information monopoly anymore. The internet, the company's websites, the various systems like Stockwatch and that, they're all now electronic. Everybody can have the information right away. The broker is unlikely to know anything more about a company unless they actually finance that company than the client calling up. So they are no longer playing that critical role of being an information hub. It's great when there are brokers who still specialize in this. They can have a group of clients who understand the game, and they can rely on the knowledge of that broker. But this is not where the financial sector is going. Clients have to look elsewhere. Maybe even newsletter writers such as myself for insights which we produce for a large audience. It's not custom advice. I'm not talking to individuals, where I'm talking to the group of subscribers saying, here's my opinion on this and that. That type of network hub is now far more important than the traditional broker, which is a sad thing because it's also a reason that the whole junior sector is in crisis.
Do you focus on the charts and/or fundamentals of junior companies?
Well, I look at both of them, and I'm famous for being a bottom fisher, and these days, okay, now you're a flatline fisher because that's all the stocks have been doing is either sinking or flatlining. But in the old days, when there was more cyclicity to the junior resource sector rather than this slow fading away from the last 8 years, you looked at the chart pattern, and when the stocks were trending up, then you would look at the fundamentals and sort of say, well, what's driving this, and what's the potential value of the story? How high can it go? And I think matching the underlying fundamentals of a resource junior, the potential outcome to how the market's pricing it right now, that's very critical. So you have to look at both of them. If you're just looking at the fundamentals and not paying attention to the technicals, you will perhaps miss that you are misreading the fundamentals, and the market may be telling you something different. And if you just look at the technicals, you're operating in a vacuum. You may not understand that this stock, which just tripled, is tripling because the context in which a hole was pulled suggests there's a 5 to 10 million ounce gold system emerging, not some little 100,000 ounce vein that somebody managed to hit at the right angle. You have to, in the junior resource game, you have to look at both fundamentals and technicals, the charts, to have any chance of not making a big mistake.
What's the hottest sector in the junior markets right now?
It has to be gold because, gold here is itching to make a new high since the pullback in 2011, 12. We did not get the bump in the junior resource sector this year that you would have expected from gold, starting from, say, 1290 at the end of 2018 and getting up to 1550 and retreating back to 1470. That's a pretty substantial move for gold. But we had the producers do well in the second quarter, and the juniors started to catch on in the summer. But after the first week of September, when the rally stalled, everything went very cold. In fact, it went very bad. I would say that period from mid-September until mid-December was a very bad period for the resource juniors. We have seen in the past 2 weeks a turnaround, and it is linked to expectation that gold's going to do very well in 2020, and for most people, just making it above that high achieved in 2019, that's going to be good. For others like me, I think we need to see gold move more sharply to really bring broader audiences. On the other hand, if gold does this slow move, we have a 1-year period during which those people with some familiarity with the sector will be able to get back in it, get a position at prices that are not over the top crazy, and start making some serious money when gold does do that exponential leap through $2,000.
Do you believe that turkey flying season still exists in the junior markets, and what exactly was turkey flying season?
Well, yes. I mean, it kind of existed in the first decade of this year when the China super cycle kicked in and base metal prices went up 4 or 5 times in real terms and managed to settle back at least 2 to 3 times what they were before the China super cycle kicked in 2003, and lots of stocks went up. Many of the exploration juniors who weren't really part of this feasibility demonstration cycle that decade was all about, they managed to tag along and do reasonably well. But since everything fell apart in 2011, we have not had turkey flying conditions. It's been a pretty dismal bear market. There was a period where there was hope that Nova, with its Pilbara conglomerate gold story, could create a global boom in exploration juniors, but that story stalled because they have not yet solved the measurement problem. I do think that if we get gold going into that $2,000 to $3,000 range, turkeys and pigs will start to fly, but the damage done in the last 8 years has really marginalized many of these lifestyle companies. I'm not sure that given how the audience for the resource juniors has aged and not been replaced by post-boomers, the Generation X millennial types, I think the lifestyle guys will have a tougher time getting anybody to pay attention. But there will come again a period where stocks are levitating, but I think it'll be a while before the rising tide starts lifting all the boats. I look at the 1,200 or so resource listings on the TSX Venture Exchange. Only about 400 of them have more than $200,000 working capital, and I just finished processing all the financials that were due by the end of December. The other 600-700 companies, they have no money. In fact, about 500 of them collectively owe about $2.4 billion. That's never going to be paid back. It's going to be converted into paper. So, we're not going to have a turkey pig flying market for some time. And when it happens, I think it'll be the more solid companies, which themselves simply get way overpriced because there isn't a lot of product. And when that super overpriced condition happens, well, then they'll start manufacturing new deals, just like we see all these, cannabis deals still coming onto the market as though people haven't realized that the cannabis bubble is dead.
Are robots better traders than people, especially in the junior sector?
Robots, when they are used to, short sell on a downtick, when a junior puts out some news and fresh risk capital comes into the market, and the stock starts to rise, the robots, they're monitoring the whole system. They detect it. They can even do some sort of AI to quickly, read the news releases to make sure that there isn't, a big barn burner hole that could really cause them a lot of grief. And so then they come in there in their automated manner and just start selling into it. And then when the incoming capital slows and then the existing shareholders, the normal longs start to worry and want to turn around and start to sell, well, the bots are in there already selling stock they don't own because they're manipulating, they're exploiting the uptrend and turning it into a downtrend that cascades ordinary investors. And so, that's far more efficient than, say, some trader, the old-fashioned trader who would sit there and watch for the incoming risk capital, check it out, and then sell into it. But in the old days, they weren't allowed to sell into downtick, so they were always at risk that they couldn't borrow the stock and wouldn't be able to cover at the end of the days. So bots are better than human beings in that regard. But in terms of picking a resource junior with an exploration play, there is no way that you could that a bot can figure out what the geological context of a target is, that if you hit something that starts to confirm the hypothesis, it takes a human mind to recognize this in advance and be able to read the tea leaves as they start to be published to realize, wow, this stock has got a winner, this is going to go to the moon. Bots cannot do that, especially not in the resource junior sector where we're dealing with, high risk type of events that can dramatically change the fortune of the companies. It's not like predicting how many smartphones Apple is going to sell and trading on relatively small fluctuations. They're not very efficient in that regard with regard to the resource juniors.
How can people find out more about Kaiser Research?
It's kaiserresearch.com. It's a website. There's a lot of free stuff available. We will be redesigning the website this year, so we have closed new individual membership registrations until the new site is ready. We don't want to confuse newcomers with it. people who were registered before and let it lapse, they can still go in there and sign up, renew, resubscribe for the 450 annual individual membership. There is the multi-user corporate membership at $1,000, which is still available. We have that available because that's really intended for family offices, hedge funds, the sort of people, groups that understand that the Kaiser research is an information portal, and they may not care what I have to say about any picks. They're using it as a time-saving tool, and they have, various staff who can go in there and do the research. If we do go into a crazy market and I don't have my new website ready, well, people might want to just do the $1,000 and pretend that they're a multi-user, but we're not there yet. We've got to rebuild the website. This one's 15 years old. It's got great functionality, but we need to build a new one and get set for what I think will be a turnaround for the junior resource sector.
John, thank you so much for being on This Week in Money.
You're welcome, Jim.
My guest has been John Kaiser. He's a regular guest on HowStreet.com radio with his show Discovery Watch. Coming up, Ross Kay next on This Week in Money.
Cypress Development Corp. is developing a world-class lithium resource in the heart of Clayton Valley, Nevada. The size of the resource makes the Clayton Valley project a premier asset with the potential to impact the future of lithium supply. Cypress Development Corp. trades on the TSX Venture Exchange, symbol CYP, the OTCQB, symbol CYDVF, and on Frankfurt, symbol C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. I'm speaking with home ownership consultant Ross Kay from the wealthyhomeowner.ca. Happy New Year, Ross.
And Happy New Year to you too, Jim.
Ross, first of all, we'll take a look at the national picture and then British Columbia for the new year.
In Canada, we're looking at a situation where Canadians simply cannot accumulate enough debt to keep housing markets moving forward. It is a mathematical impossibility. The debt to GDP ratio would have to increase even further for the housing market just to sustain itself at today's prices. Debt to income ratio would have to increase simply to maintain today's prices. To get prices to go higher, those ratios would have to increase more. Banks and governments would react accordingly. It is a mathematical impossibility. So no matter what we're talking about in 2020, I hope your listeners will take that from today's show. There is a mathematical point where the finances of a nation do not allow housing markets to continue. We are up against that wall now. We were up against it in 2017. We had a residual follow, which we call a contraction bump because of the way the housing market was structured, pending deals that had to close, and now we're moving forward. So let's start in British Columbia, as you've asked. In British Columbia, you're going to hear that sales possibly will rise in 2019. Possibly. Now, when I say with rise, I mean they're going to remain below historical lows. When you hear real estate agents or brokers or government economists or an economist or a housing analyst using this fake metric called the 10-year average. It is another fake metric created by the Canadian Real Estate Association to alleviate concerns that began in 2008 when the Great Recession hit. Prior to that date, that term was never used before. No one used the 10-year average. It was only in a recession that the Canadian Real Estate Association came out with a new marketing metric called the 10-year average. Well, what the 10-year average does, it always presents almost always presents a positive spin in the market because it's counting sales. It's not counting the percentage of homeowners that are moving in a year. Obviously, 10 years ago, there were probably 2 million fewer homes in Canada than there are today. Well, if there were that many fewer homes, obviously you need to have more sales just to stay level. Instead, we're going to compare the 10-year rate. In other words, we're only going to talk about sales, not sales as a percentage of the housing stock. Well, we talk about sales in the percentage of the housing stock. That's how my firm looks at these things. we calculate the rate of change that is taking place in the market. What you're going to see in British Columbia is, which we have already seen over the last 4 months technically, is a small increase in the average purchase price. So that will be reported by Organized Real Estate as an increase in the average selling price, which will be reported as housing prices rising. Of course, they're not. Anyone who looks at the MLS information that's available today can see that you can acquire a substantially better home in the end of 2019 than you could have at the end of 2018 in Vancouver, for the sake of the argument. The outlying markets, say Langley, Kelowna, as you get further away from Vancouver, have simply taken longer to slow down. But this is a natural flow of equity in the province, taking longer to slow up in the outer suburbs than it does in the set where all that equity flows, which in BC's case is Vancouver. So you can expect to hear early in the year local realtors claiming housing prices are rising and sales are rising. You can expect that to happen. What I can tell your listeners is this: the current housing prices that are in British Columbia are not sustainable. There is not the income across the population base, the way that we break down your population income and the housing stock prices, to support the housing prices as they now exist. Builders are going to continue to want to build new homes, because once their profits are dried up from the existing amount of homes that are being built, they're going to look to build the next set of homes, the next set of high-rise. If they can't get the prices they were getting before, because the profit margins were so high in those buildings, astronomical in some cases, they will be able to reduce the prices of their new condos. It's why these people who are talking about going out and buying pre-sales at the end of the year or the Chinese New Year are just making irrational statements that cannot be supported with the data. The builders will react. The builders want to keep making profit. If they go from making $1,000 profit per unit, for the sake of the argument, and they had to drop to $500, they would happily do it. They're going to delay that as long as possible because they want to reap as much profit as they can, but they sooner or later come to reality. And then you have the trickle down against the rest of the market. Where the risk for most home buyers is in British Columbia, as is in the rest of Canada. The quality of home available on the market today is at its lowest quality in history. What that means is, instead of having 10 homes to select from, you've only got 5. Well, obviously, if you only have 5, your selection is far worse than it would be if you had 10. And that's really a situation that we see coast to coast right now, because the national activity rate of existing owners is at its lowest in recorded history. So this is a comment, Jim, for across Canada that I'm speaking to right now. Canada-wide, existing homeowners are the least active they have been since we started recording and since data exists that allows you to measure the activity level of Canadians, which is 1980. So from 1980 till today, existing Canadian homeowners have never been this inactive in the market than they are today. Vancouver is exactly the same thing right now. British Columbia is exactly the same thing right now. It's why a home buyer is making a serious mistake if they're buying a home. You know, I think the biggest problem with British Columbia over the rest of Canada has been the willingness of local realtors in British Columbia to continue to sell people houses in the worst home buying market in history. Why a realtor would go out and encourage people or actively be a participant in them acquiring a home at a price that inevitably is going to be worth less. They're going to carry debt with them for the next 25 to 30 years that they didn't need to carry. If they had simply kept renting for another year or two, it makes no sense to me. I feel very bad for the listeners in British Columbia who are guided or assisted or not directly recommended not to purchase a home in 2018. Because regardless with what you hear in the newspaper about rising prices or increasing sales in the early part of 2020, housing prices are still falling. The activity rate of British Columbia homeowners is still at its lowest rate in history. You are simply just getting into the market at the worst time possible. Well, the second worst time possible. The worst time possible principal, of course, was 2016. So for 2020, you can expect the same stories to happen. You can expect the same misreads of the market to continue. But what I will tell your listeners is this: there is a mathematical threshold. That threshold has been passed. It is impossible for Canada to maintain today's housing prices anywhere in this nation.
We'll have more with Ross Kay when This Week in Money returns.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back. We're chatting with Ross Kay. Ross, what's your outlook for Alberta in 2020?
Well, my outlook for Alberta is not a good one. It's a challenging one. I mean, we have now placed Alberta in the same category as Quebec. Now, I know everybody's heard in the newspapers the last 2 years about Quebec being the hottest housing market in Canada. No. Their house price appreciation in Quebec has been the lowest in the last 25 years. Alberta, poor Albertan family. They're in a situation now that their home is worth less in inflation-adjusted dollars than what it was in 2010. Probably for some buyers that bought as far back as 2008. I mean, I don't think that most listeners will even have an idea that way back in 2008, the average selling price in 2007, for the sake of the argument, in December of 2007, 12 years ago, was $355,000 province-wide in the province of Alberta. Home buyers were purchasing homes on average at $355,000. Well, this December, you're going to be somewhere around the $365,000 mark. Okay, inflation alone wipes out all that difference. You also have to understand that the house that you're buying in 2019 is substantially better than the house that people were buying in December of 2007. Home buyers always seek out the highest quality of home for their home buying dollar. And in Alberta, you're getting a good selection of quality because we are now 5 years into a where the builders have had to change the way that they're building homes and what they're offering to Albertans. They're offering them more and more and more. We are now at a point where it almost does not make sense to buy a resale home in most cases in Alberta. You should only be buying brand new. Now, the good side of that is buying brand new is good for the economy. Unlike buying an existing home, which has very little real positive impact on gross debt service other than the tax dollars that are collected from all the people involved in the sale of a property. New home builders, you've got to build the house. You got to build the house, you got to finance the house for the very first time. That means if it's a $500,000 house, there has to be $500,000 worth of new funding that comes into the housing market. Whether you take $200,000 out of your bank account and then get a $300,000 mortgage, doesn't matter. That money has come from somewhere else and flowed into the housing market. What's our main concern with Alberta is that job losses, which are probably about to rupture in Alberta unless there is some change in the price of oil. Now, I'm not an economist. I'm not experienced in tracking the price of oil. My opinions on that are just anecdotal. But what I do know is that even if those jobs come back, it's going to be at least a 2-year lag before the housing market starts to turn around. So what I would say to most Albertans, the people from Alberta listening to the show, prices are really going to be dropping again throughout 2020. That's not going to change. If your local real estate board claims how home sales are increasing, they're not going to be increasing at a rate rapid enough to offset that. You're going to see your local real estate board in Calgary and Alberta getting caught once again for manipulating their data. Those real estate boards were caught in November where they had to report year-over-year negative sales for the province of Alberta. after claiming sales had been increasing for the previous 3 months. These are all just stat manipulation by organized real estate. Now, you have to understand, this is not your real estate broker's fault, your sales rep's fault, your realtor's fault. Your realtors, your sales reps, and your brokers all believe the Kool-Aid that they're being force-fed. They believe it to their core. So please don't blame realtors in Alberta for this. It's the leadership of organized real estate. It's the economists that work at their board. It's the ignorance that exists within organized real estate with how housing markets function. Needless to say, housing prices will continue to decline regardless of what your local real estate broker tells you.
Ontario is next, Ross. What do you see for Canada's biggest province?
Well, what I see for Canada's biggest province is a reality check. I mean, if you the end of this month, you know, the Canadian Real Estate Association will be announcing that prices in Ontario have increased about $35,000 this year. They are going to report that the average home price has increased about $35,000 in 2019. They're reporting this at the same time that the identical home has dropped in price over that same period of time. Because what you see has happened is that the sales have shifted more to the more expensive areas in Ontario. Because as we said on previous shows, home buyers are smart. If they can get a $600,000 house for $550,000, and they were only planning on spending $525,000, they will go ahead and spend the extra $25,000 and buy a $550,000 home, even though that home is worth $50,000 less than what it was a year before. The average selling price will go up as a result. House price illusion will be created. Organized real estate will be reporting housing prices are increasing, when in fact it's just simply because the group of buyers are buying more expensive homes. And you get this over a cycle. This is how prices rise and fall. So will housing prices repeat the pattern that happened in 29 that the organized real estate will be reporting within the next 2 weeks happened in Ontario, falsely reporting what happened in Ontario in 2019? Will they increase another $35,000 in 2020? And we'll tell you no. It is impossible. It is a mathematical impossibility. It is not going to happen. What they're basically saying, housing prices are going to rise 5%. Well, the average buyer by the end of calendar year 2020 may be restricted to only the wealthiest of Ontarians who will be buying more expensive homes. And as a result, they may be paying $30,000 more, but they're acquiring a home that will be $100,000 to $200,000 better than if they had purchased it at the end of 2019. Ontario is going to see a small increase in sales early in the year. You're going to hear reported selling prices have increased, and you're just going to hear more myths and more falsehoods. Where they're going to get caught up is in the next fall, where a repeat of this year is not going to happen, because there will be more first-time buyers purchasing in October than happened in 2019. We have never had a year in October where there were so few first-time buyers buying. What that means is that the slight increase in sales that Ontario has been bragging about are going to fall off. Telltale sign is going to be December sales in the Toronto Real Estate Board. And I encourage all your listeners to check out what the sales are going to be for the Toronto Real Estate Board in December. Because everybody has to remember, in November, they reported a sales gain. In October, they reported a sales gain. In September, they reported a sales gain. In August, they reported a sales gain. In July, they reported a sales gain. Are they going to report a sales gain in December? I don't think so. So, again, for Ontario, if you're thinking of buying a home in Ontario, simply understand you're purchasing a property that will be worth less in real terms by the start of 2021. I don't care what your realtors tell you. I don't care what the economists tell you. I don't care what the Bank of Canada tells you. If you had an appraiser out and that appraiser appraised your property today and they appraise it again next year in December, the appraisal would show a lower dollar value. There would not be comparables to show you your price of your home has increased. Those comparables would show that it has decreased.
The real estate industry claims Quebec had the best 2019 of all the provinces, and they're hoping to make it 3 years in a row in 2020. Will that happen? And did they have the best 2019 of all the provinces?
Well, if someone wants to call a national increase of 3.8%, the best real estate market in Canada, go ahead. I would say, well, if those are the metrics that you're going to use, then you better instead say Nova Scotia had the biggest increase, Jim, because of course Nova Scotia had an immigration run this year, and they didn't grow their housing stock quick enough in preparation for those new immigrants that they were welcoming to their province. You know, Quebec is a little bit different. Quebec is very restrictive with their immigration, although as people in Vancouver and British Columbia know, they were using that loophole to get cash, which ended up being transferred out to inflate house price illusion out in British Columbia. But that said, their immigration rates are not exceeding what their housing stock growth rate is, like it is in most other provinces. So do I think that Quebec is going to see another 3 to 4% house price rise in 2020? I'm going to say no. I don't think prices there are going to go up another $12,000 next year on average. One of the problems you have, Jim, when you're talking about percentage change is that people focus on the percentage. We never focus on the percentage. We focus on the dollars. In other words, a 3% house price change on a $300,000 house is only $12,000, or it's only $9,000. A 3% house price change on $1 million house is $30,000. It's two totally different things. It's why these housing markets are not sustainable. You can't keep going up 3, 6, 9% a year. That is impossible. People can't afford it, no matter how low you drop the interest rate. You reach a point where those prices are no longer sustainable. We are at that now, even in Quebec. We looked at Quebec, and Quebec's activity rate or trading rate it slowed substantially in November. We expect that it's going to reverse in early 2020. There is not the economy, the infrastructure, the housing market in Quebec to support a national average selling price of $315,000, which is where Quebec's going to end up at the end of the year when they report their year-end stats, somewhere around $315,000, $316,000. The difference in Quebec is this: Quebec, for a very, very long period of time, has maintained low house price growth. That means the quality of the housing stock has been able to keep pace with the price change. It's only at times when houses are being traded too rapidly that gets out of whack. And it has always only been the last couple of months where Quebec got out of whack, and the fact that it got out of whack was quickly whacked back down by reality. And we expect to see that again turn in early 2020. Very little risk in Quebec. That's what I will tell listeners from Quebec. Because your house price growth has been so small over the last decade, you really have very little fear of making a mistake. As long as you purchase a home that's in good condition and you plan on living there for the next 15 years, you'll be okay. I can't say that for the rest of the country.
Ross, we now have some listener questions. The first question: I'm a realtor and I work mostly in Richmond Hill, Ontario, and the Willowdale area. As you know, the prices for these two areas, especially Willowdale, had a big correction since 2017 and is still going down. But I have a big doubt about the Etobicoke area. I'm planning to buy a land value house in Etobicoke, and I'm wondering if you think that's a good idea.
Okay, so, realtors it's amazing the number of realtors that we have who become members of the wealthy homeowner to get information about their own property. Now, while they get information about the city that they're living in and the provincial and the national numbers, they can't use that information to communicate it to their clients. It's very unique. In other words, the information they're getting is very unique in terms of price change and forecasts on an individual basis. Now, obviously, Richmond Hill, Willowdale, and Etobicoke, we have many members in those areas. So I don't know if this is a realtor looking to get information so he can pass on to his clients, or it's he's not willing to pay to get the information in terms of making a massive, by the sounds of it, a massive land purchase in Etobicoke. That said, I can, if he's a genuine listener, or she's a genuine listener for that matter, I can tell them this. They have admitted in that question that Willowdale had a big correction in prices in 2017. They also admitted that prices are still going down, is what you said. Well, organized real estate isn't reporting that. Local real estate brokers are not reporting that. They're reporting that the market is recovering. There is almost a universal belief in those areas that they believe the market's recovering. It's not. Clearly the person does listen to the show because they believe what we're saying. Maybe they're looking at the MLS listing information on a granular level, and maybe they're hearing things in the show that they're able then to look at and see in the MLS, and now they're questioning. Probably they're seeing what they believe is a great deal on a piece of land somewhere in Etobicoke, but the listing realtor is probably saying that the owner won't fudge in the price. And they're wondering, because as every real estate broker knows, land is really what you should be acquiring. It's why you don't buy condos. It's why you buy single detached homes if you're investing in real estate. And that means you leave your own city if you're going to invest in real estate, like as a strict investment. In other words, you're not going to work your way up the property ladder as a condo buyer would be doing in Toronto or Vancouver. And this broker is saying, well, so this is what, if he's listening this week, this is what he needs to hear. All housing markets function in the exact same way. People believed Victoria was not going to drop in price in Vancouver when Vancouver was dropping in price. People actually believed in Vancouver in 2016 that single detached homes were such a limited supply in Vancouver that they would never drop in price. Well, we've seen across the board price reductions of 30, 40, 50% in Vancouver on single detached homes. Real estate is governed by a mass hysteria. What people believe, the groupthink, becomes reality. But reality in their own mind, it doesn't become something that's sustainable. And the moment that their mind switch the other way, oh, this is no longer sustainable, they start to go in the opposite direction. Panic selling goes the same way that panic buying happened on the way up. I mean, you certainly don't see 40% house price drop in Vancouver over the short 3-year period unless you call that panic selling. Those people clearly bought into markets that they weren't prepared to sit on for the next 15 years. And if I'm spending $1.5 million, $2 million, $3 million on a single detached home, my plan is a long 15 to 20-year plan, or I'm not entering that market. This broker who's asking should they be buying home in Etobicoke, land in Etobicoke. Look, you have to look at the zoning of the land that you're considering buying. You have to look at the surrounding zoning of all the neighboring communities around where this land is located. In some cases, you have to look at neighboring towns. In Etobicoke, you must look at neighboring towns. Because as the city of Vaughan showed, by dropping property taxes, they can get a whole bunch of new homes built. But Etobicoke is no different than Toronto. It's no different than Vaughan. It's no different than Richmond Hill. It's no different than Oakville. It's no different than my hometown of Birmingham. These housing markets simply adjust on a different timetable. They all adjust in the exact same way. It's just on a different timetable. The magnitude of change on the way up is greater in the areas where the housing stock is of the highest quality, And as it returns, it's lower, where the housing stock is of a lower quality. That's simply the way it goes. What you don't want to be doing is buying in to a market the lowest quality of home at the highest price point. That just doesn't make any sense. Would I be buying land in Etobicoke right now? I would be buying land anywhere in Canada that I knew I was going to be able to build single detached homes on in the next 15 years. Yes, I would be buying it with a 15-year hold. I would be buying it with a 10-year term mortgage on the property. 10 years, that's correct. I would pay the higher interest rate, lock in for 10 years, and commit to not selling that land for 10 years or 15 years. When my mortgage comes up for renewal 10 years from now, I would simply renew it for another 5 years, whatever the going rate is, because then I've only got to carry that land for another 5 years. Worst case scenario. It's really more on how you approach real estate investing than anything else. If you're purchasing a rental property, then you must time the market, but you also must understand what your long-term returns are going to be on that real estate investment. This isn't like stocks. You can buy and sell stocks with very little risk because you can make a quick decision. You can't make a quick decision with the housing market. And by the time you make a decision, you've already missed the window to make it happen. You need to look at real estate with a long-term outlook. So as a real estate broker, this guy needs to go back and look at the housing stats from TREB from the 1985 to 1995 period. Go back and look at those sales stats. Now, not the stats, the actual MLS listings. Go into a neighborhood and track where prices went over that 10-year window. Because what you're going to see there is exactly what you're going to see here happen again. It's going to be to a different degree. It's going to happen at a different rate. It's going to happen in different parts of the city at different times, but it's going to happen exactly the same. The pattern will be exactly the same. After you've done that, only then should you make a decision on buying land in Etobicoke. And if you are not prepared to go to that exercise, then A, you should enter our investors program because we'll do that for you, or B, you simply shouldn't do it. Those are the only two ways that you can make any kind of a real estate investing decision. Looking at the historical data, being able to look at today's situation and correlate with what's going to happen in the future, because it always happens. It always happens the exact same way. That's what real estate brokers are not taught. I understand this person did not receive any training getting his brokerage license in housing market. I understand getting his brokerage license or her brokerage license. She received no education in how housing prices go up and down. I understand you actually believe what your local real estate, Etobicoke, so this has got to be the Toronto Real Estate Board. The Toronto Real Estate Board tells you. What I'm telling you is the same thing as I've said on House Street for 2 years, 3 years. Your real estate boards have no idea what they're talking about. Those people apparently no longer exist in real estate boards. You need to get some true measures of the housing market, especially if you're going to invest in land, because generally we're talking millions of dollars.
Ross, we'll wrap up our segment of the program here with another listener question. They're asking, will home prices drop in Victoria in the new year? Ozzy Jurock, a noted West Coast realtor, keeps saying because of immigration, prices are going to rise in Victoria and inflation will go nuts. What do you think?
What do I think? I think this is another realtor selling his book of business. I think that Ozzy Jurock, whatever his name is, yes. I could sit down with him and in 5 minutes I could debunk everything that he has to say. And I don't care if this is a realtor who sold 1,000 houses over the last 10 years. Okay. So first of all, before I would listen to any realtor to start out with, if they are not averaging 50 sales a year and they haven't done so over the last 20 years, that's only 1,000 home sales, folks. Don't listen to them. They're just talking off the top of their head. It requires that amount of time before you even have the potential to understand how housing markets work. And even then, over those 20 years, you had to be a student of the housing market. People said that Vancouver single detached homes were going to keep rising in price. because of immigration, because of limited supply, because of global warming. Every single reason that could be found was said about Vancouver's single detached home. They dropped 40% in value in 3 years. I don't care what anybody says. This is reality. In the late 1980s, I was told that immigration was going to maintain Burlington home prices forever. Single detached homes in Burlington were going to go up forever. That's what I was told for the first 3 years I was in the business by everyone other than my parents. My dad, who had gone through the 1980 20% interest rate period, was the only person who told me otherwise. Now, I didn't get a chance back then. I had to do what my dad said. I mean, I was riding on his coattails when I started in the business. He was proven right, because it wasn't till 2008, almost 20 years later, before the inflation and quality adjusted house price in Burlington reached its 1989 level again. Will home prices drop in Victoria next year? Home prices have been dropping in Victoria all year. We're tracking houses, same house, in the best areas in Victoria. The best areas of Victoria.
And of course, when you say next year, we're talking 2020, right?
Right. So we have been recording all year falling house prices. Do you think the market is magically going to reverse next year? Ozzie Jurek clearly believes his own book of business. Long-term, immigration without if your population growth rate exceeds your housing stock growth rate, housing prices will be impacted upward. Now, even in a correcting market, you can still have your housing being inflated. In other words, it's not dropping as quickly as it should be dropping because of immigration. But if your housing stock growth rate and your immigration rate are not identical, and they're not shifting to accommodate the changing Canadian family, in other words, who's going to live in the houses, then there is always going to be a reckoning sometime in the future. So he is right over a 20-year window, but he's not right today. Why would anybody purchase an asset right now that is falling in price? I don't know. I really don't know. I don't understand that. The only situation where that is probably an okay, rational thing to be doing is you can't get a rental unit that is even remotely adequate for your family situation. Okay, well, that's a little bit different. But I would also say that if you can't get a rental in that's in a situation that's remotely adequate for your family, probably you should be moving your family to another city, because you're clearly being limited by affordability. And affordability with your home will dictate the life and quality of life that you're able to live. This is what we've tried to stress on the show throughout the whole year, and which we'll be stressing throughout 2020. Your house consumes the most amount of your income that you have available to spend in a month. Your house will always consume the most amount of your income that you have available to spend in a month. The better that you can reduce those costs through A, timing the market, B, getting a lower interest rate, C, getting a higher quality home that needs less repairs, D, moving fewer times over your lifetime, plus all the other letters in the alphabet that we could go through. Those reductions in cost are real, and it's important that you reduce the cost of ownership, your cost of housing, as best you can. There is no way, unless I have no other choice, and believe me, I almost always have another choice. Jim, let's be honest. I've had families go live in motels for 6 months to a year. I'm not going to pretend otherwise. I have told people to go live in a motel or in a house for 6 months to a year, and they've done it. They have come out in the other end far wealthier than had they not. It's hard. It's not easy. But so is owning a home. So is buying a home today at one price and waking up tomorrow and finding it's worth less. But your mortgage is the exact same amount, and you're going to carry that debt for the next 25 years minimum. Home prices are dropping in Victoria, and they will drop next year. There are not the supports for the current selling prices in Victoria. Victoria, no matter what anybody wants to say, is an island off on its own. Any place that you've got to take a ferry from the mainland is always going to be subject to these kind of house price pressures. So take that for what it is, as with everything else that we've had to say in today's show. But please, please, don't listen to organized real estate or your local real estate brokers or your local housing analysts who are telling you things that sound like they make sense. Because unless they can back it up and prove it to you with data, it means nothing. Demand that anyone commenting to you, giving you advice about your home ownership situation, provides you with the data, the calculation, the proof that what you're doing is making the right decision. And as we start 2020, let's all look forward to a truthful year about housing markets.
Ross, thank you so much for being on This Week in Money.
And thanks for having me back, Jim, and I hope we have a really great 2020.
It's hard to say, remember, isn't it?
It is.
My guest has been home ownership consultant Ross Kay from thewealthyhomeowner.ca. He was speaking to us from Burlington, Ontario. And that wraps up our show for this week. We'd like to thank our guests, Ross Clark, John Kaiser, and Ross Kay. And thank you for listening. If you have any questions for our guests or for the show, you can send them to info@housestreet.com. Now stand by for a company showcase update from American Manganese CEO and President Larry Reaugh. I'm Jim Goddard. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at talkdigitalnetwork.com. This Week in Money is a production of House Street Media Incorporated. Executive producer is Tom Allen. Welcome to Company Showcase, an advertising feature on HouseStreet.com.
I'm Jim Goddard. I'm speaking with Larry Reaugh, CEO and President of American Manganese. Welcome back to the show, Larry, and Happy New Year.
Happy New Year, Jim.
Larry, where is American Manganese going in 2020?
Well, it's looking like an exciting year for the company. And I think it's an exciting year for the market. We're seeing a lot of strength in the markets in the last week. So, looks like the venture exchange has broken out and, led by gold, which is making highs every day. And I think it was the last I looked was 1550. So, it's going to be a very exciting time. Technology stocks are going to be booming, and of course, we're deep in the center of that. So I see a real good year coming, and I know a lot of people are saying, "Look out! It's going to get, you're going to get blindsided." But we've just gone through a big warrant exercise, and so we have a good treasury to get things started in the new year, and we're looking forward to it. Work is ongoing at Cometco with the skeleton crew. They won't be back to full force until next week. And but they're working away on the DOE scrap material, not scrap but battery material. And we're looking forward to meeting with Cometco early in the week to lay out the plans for what we'd call a PIA and mining, preliminary economic evaluation, which will give us better numbers and better timelines. So that's a big positive, and I want to just say that today we're going to have a look behind the curtain. Management and the company has been criticized because we haven't done a deal yet, but, it's not quite mature enough. Any project out there is not mature enough to bring in the big bait. But aside from that, if we'd have done a deal earlier on, there's a few things that could have created problems for the company. First off, when we were looking at the scenario for batteries, there was what they called the tipping fee. And if you were a manufacturer of batteries, or if you were the DOE or the Department of Defense or any of those ones, you had to pay a scrapyard a $4 to $7 a pound tipping fee to take the battery. And so the scrapyard would get, $4,000 to $7,000 in the kitty right away. And then, of course, they'd dismantle it and probably ship it off to a smelter. So, but today, it's a different story. The scrap yards have to pay for batteries. They have to pay for scraps. And so that's a big turnaround in what was going forward back in 2016 and 17 to what's happening today. Instead of getting money in immediately, you got money going out immediately. So that kind of tips the scale a little bit. So what's that tell you? It tells you that you have to work on efficiencies. And efficiency means that you've got to have a better method. You've got to have a cheaper cost than any competitor may have. And that's what we've been doing. We've got our patents, and we're developing a third patent, and we're reducing the costs of reagents, for example, and throughput, for another example. And, so that puts us in the front tier, or you might say a tier 1, in as far as battery recycling goes. Because without those efficiencies, you could find yourself into trouble. Now, if we'd have done a deal here even a year ago, we would have been working with numbers that were much higher in the batteries for cobalt. And now that's been reduced down considerably, the cobalt has. And so that changes the whole dynamics of any deal that you make. So now, with efficiencies, we're able to still see a lot of blue sky in what we're doing. And so that's not bothering us too much. But a deal with a supplier or somebody who would give us the scrap material, or the manufacturers, has to be well thought out. And, you try to see what's coming around the corner. I don't think we saw that cobalt was going to be reduced so much as it has been in order to reduce the battery manufacturing costs. So, that could have been a real trap for us. So, you got to look at all these things. You've got to try to corner a market. We know where there's scraps. We know where there's scraps all over the world. We get offered scraps all the time. And but there's a cost to it, and you can't go into a deal spending too much money for scrap and then finding out that the chemistry's changed, the price has changed, and you're looking at a different set of dynamics at the end of the day. So you have to be very careful. And we haven't done a deal, and we don't plan on doing a deal until we got everything nailed down. The unknown is the unknown, but the expectations of things changing are certainly in our sights, in our immediate sights. So we see changes. We've seen so many changes in this business in the last 3 years that a deal made even 2 years ago may have been harmful to the productivity of the company. So people that are saying, hey, why haven't you done a deal yet? Well, first off, we haven't done a deal because the battery manufacturers don't feel the timing is right for them. And secondly, we're probably not prepared to actually sit down and put into paper hard costs of what it would cost us for the material and then what we get back for it, because they'll be looking for reductions. So, there's a lot of things to look out for. You can't just, it's not something that is out there. There's not a pattern of recyclers that you have, you can follow on doing a deal. So here we are. We're very happy with our results. We're very happy with our progress, and we're looking forward to a great 2020. So but you have to remember that the landscape keeps shifting, and and we don't want to, be premature in doing something that could hurt the bottom line down the road. When we first got involved in this, it was pretty simple. One of the big battery types of batteries out there was the lithium cobalt, and so that was nothing but money. But the price of the cobalt was $10,000 a ton. It's 3 times that today, but the amount of cobalt is down about 90%. So, one partially balances off the other. So, it's something that we have to consider as management. We have to be prudent. We can't be stampeded into doing a premature deal that could hurt the growth of the company down the road. And looking at that, I would sure like to be able to put our first demonstration plant in with our own money, and that would give us a real pivot point to either do some basic deals down the road with battery manufacturers, recyclers, people interested in making money, companies that see this as a big opportunity. And I think, that we may end up with a company that sees this as a big opportunity. And so we're going to dot our I's, cross our T's, and, keep a close watch on everything that's happening so that we can capitalize on what we're doing. Now, it's not just the environment. Certainly we'll be saving the environment. We'll have a closed circuit process that's nothing back into the environment, and but it also has to make money. If it doesn't make money, it's not going anywhere. And so that's the idea of all this research and development, all these patents. We've applied for patents in 7 other countries, and to protect us and protect the shareholders. So that's kind of the way we're going. Now, I've attached some articles to this podcast, one of which was done by an actual recycler, and so they probably know more about that business than anybody else does. And their title was "Battery Recycling Matter of National Security," and I like that because that is what the U.S. is all about. And recycling should be high on their list. But they did make a quote in there that that half the cost of the cathode materials for the battery was the raw material, and the other half was the treatment of that raw material to make it cathode ready. Now, as you know, we've been talking about cathode to cathode, and which means that our product at the end of the day, like we did for the Tier 1 companies, is high purity, very high purity cathode material. That's going to save the battery manufacturer a lot of money. And so there's a lot of incentives for them to do something with this, and we're looking forward to something happening in the near term, or, sometime this year anyway. So that's kind of what my podcast is all about today.
Larry, for people new to American Manganese, what's the company all about?
American Manganese is a critical metals company that has a strategic deposit of manganese in the U.S. and a process for treating very low grades. And that process was the cornerstone of our technology for the battery cathode materials now, so it's nailed down twice. And so we've got 2 patents and a third one that will be applied for. So we're definitely looking at mining batteries. And when I say that, we're talking about recycling them in a manner that is not harmful to the environment and could be very profitable for the company. Now, we're traded on the Toronto Venture Exchange under the symbol AMY. We're traded in the U.S. under the symbol AMYZF. We're traded in Frankfurt under the symbol 2AM. We have a great website out there, AmericanManganeseInc.com, where you can do all of your due diligence. You could go to our pro forma business plan on a 3-ton per day plant that would be a demonstration plant, but could also be very profitable. And you can reach the company by phoning 778-574-4444. You can email me at LREAUGH@AMYMN.com.
Larry, have a Happy New Year.
Thanks, Jim. Have a Happy New Year.
My guest has been Larry Reaugh, CEO and President of American Manganese. I'm Jim Goddard. Our conversation took place on January 3rd.
Comments made on Company Showcase are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at HowStreet.com. Company Showcase is a production of How Street Media Incorporated.